Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. The biggest unknown for financial markets continues to be inflation and what that means for interest rates. I wanted to simplify the issue today, look at why inflation is so important, what's causing the current situation, and what it all means for everyday investors. Roger Montgomery is the founder and chief investment officer of Montgomery Investment Management. Roger, welcome back to Fear and Greed.
Good to be with you, Sean.
Now, recently you wrote an article about inflation and explained some of the background to the supply chain bottlenecks. In particular, you talked about the aluminium and energy crisis in China. Can you just run through that again for us?
So what's happened is since the pandemic hit, basically when the pandemic hit, everything was shut down. And consequently, there was no expectation, or it was shut down because there was really no expectation that demand would be picking up. In fact, we were heading towards a recession, a very severe recession. Everyone was locked down. No one was spending. You might remember all the images being projected around the world of empty streets and empty cities. But what actually happened is while people were locked at home, they were buying stuff and ordering stuff at a much greater rate than they had been prior to the pandemic. And so that caught the entire supply chain for goods off guard. And let's not forget that because people couldn't spend money on services, they couldn't spend money on going to the cinema or a concert and so forth, or restaurants. So even more money was directed to spending on goods than would normally be spent on goods. And so there was this enormous mix shift towards goods. And there was a shortage of not only some of the raw materials because production was shut down, but there was also, mothballed logistics in part of the supply chain. And so consequently, everyone was caught off guard in the supply chain. And on top of all of that, you mentioned aluminium, but when you look at semiconductor memory chips, we've had enormous demand of those chips from Bitcoin miners. As there are fewer and fewer Bitcoins left to mine, the algorithm required to be solved in order to earn that extra Bitcoin is much more complex. And so more computing power is required to do it. And so consequently, more computer chips are required. And so the demand for those chips went through the roof. And that, of course, really affected supply for manufacturers of other products that use those chips. For example, modern vehicles, laptop computers, smartphones, and so on.
Okay, and I mean, it's really easy to understand the electronics in that, but I was listening to an Adidas investor call, this is probably a couple of months ago, and they get a lot of their shoes out of Vietnam. What happened there was they just couldn't get supply out of Vietnam because Vietnam had closed down. And so if you bought a pair of shoes, you couldn't actually get them. So it hit all parts of the economy, it seems.
Yes. And so prices of products went up. So if you reduce supply of anything and competition for the purchase of those things increases, then what gives way is price. And so suppliers increase the price. And that feeds into CPI. It feeds into inflation.
So before we get on to kind of what happens next, something else that you wrote recently, you talked about just-in-time inventory management.
Yes.
Which is a Japanese, well, it may not be a Japanese construct, but they certainly made it famous.
Yes.
When I read that, I thought, I totally get it now. Just explain that.
So in the late 80s, the Western world's business schools got really excited about JIT, or just-in-time inventory systems. And it's the idea that you don't manufacture for warehouse storage, which is expensive, takes up space, it costs money. You manufacture to demand as it's demanded. And in an ideal world, in a perfect scenario, someone orders a product and it doesn't exist when they order it, and you're manufacturing it to order. So we see it. It was actually introduced in the furniture industry in Australia by Anthony Scarley, Nick Scarley's son. In the old days, you would walk into a furniture store, you'd see a couch, and you'd take it home. And now you see a couch or a sofa, you order it, and you might get it in 12 weeks' time or 16 weeks' time.
Yeah.
And so that's the just-in-time inventory system at an extreme, where it's not actually being made just in time for the order. You have to wait for it.
Yeah.
And so it's the other end of the spectrum. But that meant that we didn't have the product ready to go to service the demand And so everyone has to wait for the production to ramp up again in order to deliver those products.
Stay with me, Roger. We'll be back in a minute. My guest this morning is Roger Montgomery, founder and chief investment officer of Montgomery Investment Management. Okay, so where are we now in terms of inflation and then what I think people are calling just in case? But let's go to inflation first. What's happening there?
So in the United States, what happened is at the end of October, the US reported inflation of 6.2% year on year. That's not the headline rate. Sorry, that's the headline rate, not the core rate. The core rate is just under 5%, about 4.6% or thereabouts. But the 6.2% inflation rate that was reported was much, much higher than what the Fed had forecast back in March. So prior to Jerome Powell's statement on the 28th of April, the Fed had forecast calendar year 21 inflation of about, call it 2.5%. And then in September, they upgraded their forecast to 4.2%, and it's now come in at 6.2%. So it wouldn't be a problem but for the fact that there are a lot of commentators and investors who fear that the US Federal Reserve has got it wrong. Because that forecast is so far out from what's actually transpiring. It's accelerating at a faster rate and its absolute value is higher than what was anticipated. And so if the Fed's wrong about that, what else are they wrong about? That's the fear the market has. And so the market is concerned that the Fed is not only behind the curve, so to speak, but is actually asleep at the wheel. And so you're reading some commentators, even in Australia, saying that the Fed is unqualified to be managing monetary policy. They really should be stopping all quantitative easing now, and interest rates shouldn't be at zero. They should be at 2 or 3%. And so I think personally that's ridiculous. And the reason why I say that's ridiculous is because I do believe that the Fed is right to say that this current bout of inflation is transitory, that it will in fact pass, it won't be persistent. And just the base effect alone, which we can talk about in a moment, will next year cause fear, uncertainty and doubt, or what we call FUD, about inflation. It will turn into a celebration of disinflation.
Right. So just why is it transitory? Is it because things are back online, people are starting to produce again?
Yes. So, for example, if we take the bulk dry index for shipping, which admittedly doesn't affect the cost of shipping an iPhone, but it does affect the cost of shipping coal or iron ore, for example, that has already fallen, and that's a big part of the supply chain, right? Shipping, that's already fallen 50%. So even as commentators in the press are writing about the inflation scare, some of the inputs into that inflation or some of the indicators that suggest the supply chain is tight are already easing. And so that tells me that we're already seeing capitalism work. And when I say capitalism work, what I mean by that is we're already seeing that economics 101 response to higher prices. So you get higher prices, people produce more, they do everything they can to start producing more of that particular product because they can generate a higher margin.
Yep.
And so they do, and that pushes the price back down again.
If I bring this back to the just-in-time argument, now there's all sorts of talk about just-in-case, the idea that you actually start filling up those warehouses rather than doing a just-in-time style process. Is there a chance that though, will keep prices high because it might be slightly artificial, but if people are trying to fill warehouses for the next couple of years, so this doesn't happen again, that there will be price pressures still?
I think it's a nice idea, but if you think about the way business works, why would business want to buy more of the product that they may or may not need and potentially take a hit to margins, especially listed companies where stock markets are not patient, stock markets aren't willing to wait for that asset turnover to improve. And so consequently, I just don't see that happening. I see business saying, you know what, we're going to get enough to meet current demand, but we're certainly not going to be a squirrel and store away for the winter because it is expensive, it does affect margins, and it will affect stock prices because the stock market isn't patient.
Okay, so let's bring it all back to investors. So if inflation is more transitory than permanent and things start getting back online,
yes,
what should I as an investor be thinking about? What's the key message I need to take away?
Well, let's just explain why it will be transitory. So the reason why it's 6.2% today is because 12 months ago it was virtually zero. And so any number above zero looks like a big jump.
Yep.
But next year, even if prices continue to go up, and they will, but they will go up at a slower rate relative to the current 6.2%. And so next year we'll see 4 or 5% or 3%. And so when you've got consecutively lower rates of rising prices, so this year's 6.2, next year's, let's say, 4 or 4.5, then you've got disinflation. And this is the message for investors. Ever since 1978, when Gavical Research published a framework for thinking about inflation and economic growth, what we know is that in an environment of disinflationary economic growth, so where you've got the economy growing positively and you've got disinflation, which is what I've just described, consecutive rates of lower inflation, in that environment, innovative growth companies with pricing power do very, very well. So there's every possibility that next year we will not only see the equity market do well, but we could see some sectors of the equity market, innovative growth companies, for example, do exceptionally well. And what we haven't talked about is we haven't talked about wages as well. One of the other criticisms is wages are rising around the world, and we're seeing pockets of very high wages growth. Well, in actual fact, in Australia, the Reserve Bank of Australia has said, Philip Lowe has actually said, we need 3% wage growth before we see 3% inflation sustainably. And we don't have that. In fact, it's only in the construction sector and in the services sector that wage growth is approaching 3%. Everywhere else, it's nowhere near it. So we don't have that. And any wage pressures that we're currently seeing are going to very quickly, and this is true in the United States as well, are going to be very quickly relieved by the opening of international borders and the return of immigration. And Scott Morrison, just on the weekend, was talking about getting skilled and unskilled workers back into the country as soon as possible and getting 750,000 foreign students back into our universities, which, by the way, will generate about 250,000 jobs. So we're going to see those pressures on wages relieved as well. And then longer term, we're going to return to the environment that existed prior to the pandemic, and that is where we have disinflation and lower wage growth structurally. And the reason why is because it's very simple. We have something like 30% of the union membership that we had 30 years ago. So we've had a 70% decline in union membership. So that means we just don't have those big annual wage increases that we had. And that's true in the UK, in the United States, and in Australia. So union membership has declined by about 70% in all that time. And the other thing that was happening prior to the pandemic and actually accelerated during the pandemic was investment in automation, investment in the technology that displaces labour, that puts people out of a job. And that is going to continue to accelerate. In fact, McKinsey estimate that something like half of the jobs that people do and are paid for could be automated in time. And that's something like $15 trillion of wages that could be displaced. So that trend is in place. That is structural and it's not going away. And it means that we're going to see structurally lower wage growth, structurally lower inflation, and therefore structurally lower interest rates. And that's really positive for equities.
So the take home, innovative
growth companies,
price-making growth companies.
Yes, correct.
Fantastic. Roger, thank you very much for talking to Fear and Greed.
A pleasure, Sean.
That was Roger Montgomery, the founder and chief investment officer of Montgomery Investment Management. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.